Hello, I'm Rich Posson, CMT. This is an update on the stock market. We're using the Dow Jones Industrial Monthly Bar Chart. I'd like to show a 9-year cycle back in 1990, had a collapse, had a recession, and then a bull market right into a 9-year cycle in 2000. And then we see a pullback into 2001 recession, and the stock market actually bottomed out as late as 2002, I believe. And then you can see the market started up again and into a 9-year cycle, which topped in 2007, which is a little bit rare, and on the earliest side allowed, it really spans out about 8 years. The 9-year cycle spans about 8 to 13 years. It's probably similar or the same to the juggler cycle, often talked about in economics and in some markets, investment circles. The juggler cycle relates to a recession that occurs every decade. My definition is a little bit different, and the timing is a little bit different and more accurate in my opinion. At any rate, we see the 9-year cycle peaked in 2007. The market collapsed into the Great Recession and into a 72-year cycle bottom, which means there's a series of 9-year cycles that created a 36-year cycle bottom and a series of those that creates a 72-year cycle. In the past, they have related to depressions. So it's a super cycle. We were due for depression. We did not get the depression thanks to the management of our economy and money system, but we did get a Great Recession. The most serious correction since the 1930s, which was a 216-year cycle, meaning a series of 72-year cycles came together in the 1930s for the Depression. Now the market rallied into a 3-year cycle top, should have come down into a 3-year cycle top with the QE. It distorted it, started on up through this bigger bull market in a 9-year cycle, then came concerned over QE. I think we were actually backing out of QE, brought it back into a 3-year cycle, and there's a bunch of politics there that made things some more volatile. Then we get a little more normal action, and yet also maybe not normal in the sense that there wasn't much downside. This was really just a flag consolidation sideways from a 3-year cycle top into a 3-year cycle bottom, and then the trend was up, and we recently put in a 3-year cycle top. And this is a bit different than what I've been forecasting in recent months. I kind of felt like it was really 2014 for the 3-year top and bottom. Now I think that it's topped here right around May of 2015. We've had the collapse, but unlike some people who believe the market is just getting started on a bear market, I think we've probably just recently placed a 3-year cycle a bottom. And again, these are brief corrections or consolidations, and the result is a reason behind that is it's in a larger uptrend. It's in a 9-year cycle bottom up from this 72-year cycle, and it's heading into a top around 2018 to 2019. Now, there's some scenarios when you can come up with 2015 to 2016 in terms of the number of years, but you don't have enough 3-year cycles inside of it, and cycle series analysis is like a clock, and if you don't have all the hands working on the clock and all the gears, then you really don't have a model at all. You don't have a correct analysis. And the result is we just don't have enough 3-year cycles for a 9-year cycle top. So this is going to come in late. I think the earliest, though, is around 2017. But we may just see a 3-year cycle top around 2017, 2018, pull the market back, and then another 3-year cycle top, 2018, 2019, which would then trigger the latest allowed, let's say, for that 9-year cycle, right around 2019. So I think there's more upside action here to come in the stock market. We just got to get through this nonsense we've seen here in the recent month, the tremendous volatility, the over-speculation to the downside, the panic kind of mentality, and get back to a normal market, and I think it's going to grind higher. And I'm coming up minimum objectives for the 9-year cycle from a variety of techniques. It's probably going to be around 20,700 for the Dow Jones Industrials. Thank you.